hope I can be heard. Welcome to this session on the webinar on the budget proposals. I hope you have all received a copy of our detailed commentary, which has already been circulated and has been a tradition of the firm for more than 40 years for sure, and maybe 50. Today, we are going to be dealing only with the direct and indirect tax proposals. Some large ones like the change in the slab rates, MLI taxation, etc., did find a mention in the finance minister's budget speech, but there were unfortunately 122 amendments, none of which had a mention, some of which were salient enough to be also covered by our panel of experts today. I need not give a very detailed introduction of our panel, as most of you are clients, friends, and associates of the firm, and therefore familiar with all of them. Mr. Mahajani, a senior partner in our firm. Mr. Kalpesh Natkat, a partner, also a partner in our firm. Mr. Viksit Bhargava, a senior director in our firm, would be covering the direct tax proposals, whereas the indirect tax proposals will be covered by our senior director, Mr. Kumaraveli. Just a word about the format of this webinar. After each of them take you through the salient amendments in the budget of 2023, there will be a question and answer session, which has been enabled through a chat box, which you will find below in the toolbar of this webinar. In case we are unable to answer all your questions in this time period, we do have each of your email IDs and would be sending you a reply soon hereafter. Keeping in mind the time and the various pressures on it, I will, without much ado, hand it over to the experts to take you through the provisions. Thank you for your participation. And we also, as usual, look forward to your feedback.
Thank you, ma'am, for this introduction on the various aspects which were been laid down. So, as ma'am said about various amendments which have been made from the perspective of direct tax, GST, and customs, we will be taking through each of them. The important ones we have taken it. Actually, after a long time, we got a feeling that certain reliefs have been granted to the individual taxpayers in terms of new tax regime, which has been, although appearing, have been there on the Finance Act, but some changes which are in positive sign. It appears that the finance minister wants all of us to read the new tax regime, analyze the same, and also consume the same. In addition, various changes are proposed from the personal taxation, corporate taxation, M&A taxation, trust taxation on the subject. I'll be taking care of from the personal taxation and some of the corporate taxation initially. As we all know, the new tax regime was always there, but it was restricted only to the individuals and HUF. Now the benefit of new tax regime has been also extended to AOPs, EOI, and artificial jurisdiction individuals. Finance Minister mentioned that the new tax regime will become the default tax regime, and the taxpayers intending to go with the old tax regime will need to opt for the same. That's a change which is going to happen, and I'm sure there's a form which will be also issued to the same extent. If you compare between the existing slab rates and the revised slab rates, you will see there are 5 slabs in the new revised ones. So there's a reduction of one of the slab. Now, proposed change, if you see from the perspective of if you are earning an income of 15.50 lakhs, you would be saving roughly an tax of around 54,600, which is quite substantial. As far as the new tax regime goes, if you are earning income up to 7 lakhs, you will not have to pay any tax under NTR, and it will give a benefit of roughly around 30,000 in tax savings. One more important point and amendment which is there is the reduction in the highest rate of surcharge under the new tax regime. Presently, the maximum marginal rate is 42.74% for individuals having income up to exceeding INR 5 crore, which is among the highest in the world. this rate of surcharge, which was there of 37%, has been proposed to reduce to 25%. This would result in a reduction of the maximum marginal rate to 39% from the 42. So therefore, around 3.5% saving which is there. If you are following the new tax regime, earlier you were not getting the standard deduction which is available under the salaries. This standard deduction will now be available to the salaried individuals and pensioners. Opting for the old tax regime has now been extended to the new tax regime. As far as the leave encashment exemption is concerned for private companies, it has from 3 lakhs to 25 lakhs. Of course, right now it's just a finance minister speech which talks about this, but a notification is expected to be issued in the same. The new rules are expected to be notified for rent-free accommodation and for concessional rent. So there's a separate explanation which was there is proposed to be deleted, and there's some rationalization which is there. So I think it should be more or less the same. Let's wait and watch what would be the new regime. As far as the capital gains exemption under 54 and 54F is concerned, as we all know, Section 54 and 54 allowed deduction on capital gains from the transfer of long-term capital assets if the assessee purchased or constructed any residential property within the prescribed period. In order to prevent the high net worth individuals claiming substantial deductions by purchasing expensive residential houses, it is proposed to limit the capital gains exemption under both these sections. Accordingly, an amendment has been made which says that if the cost of the new asset which is purchased or constructed is more than INR 10 crores, the cost of such asset shall be deemed to be INR 10 crores. So the deduction which will be available will be available only up to 10 crores. There's a change in the taxation of the market-linked debentures. The returns on listed market-linked debentures, as we all know, are dependent upon the performance of the underlying securities. These may not be any, they may not have any coupon on such MLDL or only have a premium on redemption. Of course, the gains on long-term capital gains traditionally were taxed at the rate of 10%. And there was a feeling that, this since because these are in the nature of derivatives, it should be taxed at the rates applicable to the assessee. In fact, you must have also come across these MLDs have been issued by many companies, including Reliance Capital, Kotak Mahindra Investments, Access Finance, Motilal Oswal Home Finance. Now, what is proposed is very important. What they have said is this MLD, which is there, market-linked debentures, will be in the nature of short-term capital assets, and any gains arising on the same would be taxable at the applicable rate, for which a new section 50AA is proposed to be introduced, wherein the full value of consideration, whatever is received or on a transfer or redemption, would be reduced by the cost of acquisition and any expenditure in connection with such redemption, and the balance would be treated to be in the nature of short-term capital gains. Partial withdrawal of exemption under Section 1010D on life insurance policies issued after April 1, 2023. This is a very important one. As we all know, earlier, the sum received from LLP, from LIC was exempt. It's only in Finance 2021 an exemption was withdrawn, wherein to the extent of ULIP premium, if you pay in excess of 2.5 lakhs, which was then provided under Section 1010D. Further, to widening the tax base, a new provision is proposed which says sum received from LIC bracket other than ULIP would be taxable as income from other sources where aggregate premium exceeded INR 5 lakhs. So up to 5 lakhs is there is not a problem. Anything above 5 lakhs, if your premium is, then in that case, any income which is arising from that policy would be taxable under the head income from other sources. Of course, whatever premium what you have paid, you'll get a deduction against the amount what you receive, and the difference will be treated to be income from other sources. In case if you have claimed any 80C deduction, then to that extent, that premium would not be allowed to be reduced from the amount so received. Sum received on death, not taxable. It continues to, as is the case, maybe Section 1010D would be available, exemption. Interest on capital borrowed for acquiring, renewing, or reconstructing a house property. Under the existing provisions, interest payable on borrowed capital for acquiring, renewing, or reconstructing a property is allowed as a deduction up to INR 2 lakhs per annum under Section 24 of the Act under the head income from house property, as we all know this. In some cases, assessees were claiming double deduction for interest. One, by claiming it under 24, and secondly, by reducing at the time of the sale as treating this interest as a cost of improvement. So what was happening is there was a double deduction which was claimed by the certain taxpayers. And there were some disputes also which had arisen from with the department. Some of the decisions have decided this matter in favorable in the hands of the assessee, and we have said that double deduction is allowed. Delhi ITAT in case of Ashok Kumar Shahi, Gayatri Maheshwari Jodhpur Tribunal in 2070, Andhra Pradesh High Court in 1976 in K.S. Gupta. At the same time, there are adverse decisions rendered. One in the case of Sri Bal Properties and Finance Mumbai ITAT and Captain Linga Raju Bangalore ITAT 216. Therefore, to come out of all this perspective, interest, there is an amendment which is made which says that interest shall not be capitalized in the value of property if you have claimed a deduction earlier. This is basically to prevent the double deduction which is there. And therefore, an amendment is made in Section 48 of the Income Tax Act. Taxation of electronic gold receipt. In order to promote the concept of electronic gold receipt, it is proposed to insert Section 47(7)(d), wherein it says any transfer of physical gold into the electronic gold receipt or vice versa shall not be considered as a taxable transfer for the purpose of capital gains. Of course, at the same time, there's another amendment which is proposed which says that if you are selling it actually, then original holding period which was there, let's say for example, today I convert the physical gold into a electronic gold. So if I hold the physical gold for let's say 2 years, and thereafter I have sold it after 1 year, what will happen is you will be taking 3 years as the original holding period for the purpose of computation of capital gains. And same way, original cost of acquisition which I had bought it at for the physical gold, I will get it as a deduction. I'll move to corporate taxation. Incentives for IFC unit. With a view to promote and create world-class financial infrastructure, government has been incentivizing the units located in IFC. To make the IFC more attractive, the budget proposes to have additional tax incentive. As we know, currently the time limit of transfer of assets. So today, if you have an offshore fund, and you wants to migrate himself to the IFC, what is happening is you relocate the full along with his assets. So if these assets are located from the offshore origin fund to the IFC, what means is there is an issue of whether this is considered to be a transfer. There is an exemption which has been provided, which says that if you are locating it, any particular asset or any benefits which is happening would not be considered to be taxable transfer. And if you do it between March up to March 31, 2023. This particular date is proposed to be extended to 31st March 2025. Of course, consequently, any timeline for exemption to shareholder, unit holder, interest holder has also been extended for that. Coming to the offshore derivative instruments, which are issued, to the non-resident by the OBUs. As we all know right now, under the existing provisions, if there is any transfer of overseas derivative instrument by the non-resident, then that capital gains which are arising in the hands of the non-resident is currently exempt from tax under Section 10(4)(e) of the Act. But this is only in respect of the transfer. That is what. But what happens to the income which is arising from this offshore derivative instrument? Income in the form of the capital gains, it could be the interest or dividend. Here, there is a new amendment which has been proposed, which says that all this capital gains, interest or dividend, which is arising from the offshore derivative instrument, basically the income, would be exempt if the offshore banking unit is not paying tax on the same. Today, what was happening is both the entities were paying taxes. Offshore banking unit, when it was getting this income, they were also paying taxes. And when they were distributing it to the non-resident, they were also paying taxes. So therefore, to mitigate that double taxation, this amendment has been brought in. And this amendment has been made under Section 10(4)(e) of the Income Tax Act. Benefits for startup, as usual, there's benefits which have been provided. As we all know, roughly around 80,000 startups are there and 100 unicorns are there in each state of India. And substantial capital has been invested by the venture capital fund and the private equity fund which is there. So deduction under 80IAC, if you recollect, currently Section 80IC provides for profit-linked deduction to taxpayers being eligible startups for a period of 3 years out of the 10 years for companies incorporated before 1st April 23. This proposed date is proposed to be extended to the 31st March 2024. Eligible startups to carry forward business loss by during the initial year. Like to give a background to this. As we all know, Section 79 restricts the carry forward and set off of business loss in case of closely held company, for which there is a separate definition under Section 218 of the Act. It says the carry forward loss is allowed to be set off only if at least 51% of shareholding remains the same as on the last day of the previous year to which the loss belongs. So if you are the day when you want to set off the losses, what you have to ensure is the shareholding as on the year of set off and the year holding in the which the loss was incurred, you need to have at least 51% same people. There's an exemption of proviso which was provided under this, which says that there is a exemption to the eligible startup which have been recognized under 80IC, which says that if all the shareholders of the company, as on the last day of the year in which the loss was incurred, continued to hold on the last day of the previous year in which the loss is actually set off. So here you don't have this 51% test. What they're saying is that whoever were the shareholders at the time when the loss was incurred, they should continue to be there at the time when actually it is set off, want to set off. But if there is a caveat to this, it says that if the loss is incurred during the period of first 7 years from the year in company which incorporated. Now, this 7-year period is proposed to be extended to the period of 10 years from the date of incorporation. I don't know for the reason why, how does it benefit, but if you see, what they're expecting is that whoever has continued to be the shareholder should continue in the time of actual setup. And as we all know, there's a lot of substantial ESOPs also which are given. I'm wondering as to how this really would be beneficial, because we are expecting that the employees who were there with the company should continue to hold those shares, at the time when the actual loss is incurred. So I don't know how much benefit will be available, but yes, this is one of the benefit which has been proposed. We must have heard a lot of things on the angel taxation from 2012 onwards, including the latest amendments which have been coming. And I'm sure you would have read about the newspaper also that the startups are not happy with the amendment which has been proposed. It's very important, we need to be a little careful on this section. As we all know, 5627B provides that where a closely held company receives any consideration from a resident for issue of shares. The shares could be equity shares or preference shares or CCPF. Exceeding the value of such shares, the aggregate consideration received for such shares as exceeds the fair market value of the shares shall be taxed in the hands of, under the head income from other sources. Means you'll be taxed at the highest rate what is applicable to the company. Now, how is FMV determined? FMV has been prescribed under the Rule 11 UA, which has been there. And it provides for the two methods, like one is the breakup method, which is provided. Second is the discounted cash flow method, which is to be determined by a merchant banker. This provision, as on today, provides that this will not apply in case of non-resident investors and the funds registered with SEBI. SEBI means basically the AIFM. Okay, this is there. The question which comes up is what happens to foreign venture capital fund? If you see right now, they have said that non-resident would now get covered under this 5627. Unfortunately, the government has not clarified as to whether any such specific exemption would be available to foreign venture capital fund who have been investing a substantial amount in this startups, similar to what funds registered with SEBI, that is AIF and all. I think some leeway we may expect from the government. Let's see what happens. Second is the DCF method. Now, generally, as we all know, the people who are basically issuing the shares, the valuation is done under the DCF method, and it's derived based on the value of intangible and tangible assets. In fact, there was a survey which was done in 2019, and where it was stated that there are some certain startups who has raised capital between 50 lakhs to 2 crores, and they have received an angel tax notice, and I think around 73% startups had received these notices. Let's hope that something very similar does not happen again in this case, where the shares are issued to the non-residents. TP compliance. This has become very, very important now. If you remember, in TP, normally what we used to do is disclose this transaction in Indian issuing company, and no benchmarking was required to be performed. Basically, on the rationale that the transaction was not taxable under 5627B. Now the Indian companies would have to be very, very careful and do more detailed analysis and proper valuation report to argue that Indian company has entered into the transaction at fair market value. That is at arm's length price, and no excess money is received. So TP has become very, very important now. Once again, we need to be careful in the valuation report what we will be getting for the same. Valuation under different laws. Okay, this is very, very important, because if, as we all know, under FEMA, the shares have to be issued at least at the fair market value. So let's take an example. I do a valuation, and that valuation says that 100 is the fair market value. I have to ensure from the RBI perspective, I can issue the shares anything above 100 and 100 and above. Now what will happen is, suppose let's say I issue at 120. RBI will say, okay, fine, I don't have any problem. Why? Because I'm getting extra money. Where is the concern? Whereas income tax will say, no, you can't do it. You have to do it at 100 only. 100 only. Means extra 20 you pay tax. So if you see both the methodology and both the laws, actually speaking, there is a dichotomy. And the only way what I could see is that the shares will have to issue at exactly the fair market value. It would be interesting to see whether this issue gets addressed before the passage of the bill. Business reorganization. Section 170A, which was introduced by the Finance Act 2022, which is there, and which said that, to provide for giving effect to the order of the business reorganization issued by the tribunal or court. Now, there was no provision for the procedure to be followed by AO after the modified return is furnished by the successor company. Now, this section has been amended, and now the AO can compute the income based on the modified return, irrespective of filing the ROI date. Only one thing is, they have said business organization is defined to be amalgamation, merger, and demerger. A question which would need an analysis is whether, if you have a court-approved slum sale, how we will handle this particular aspect. Taxation for REITs, InvITs, and unit holders. If you remember, Section 115 UA is there, which provides for a pass-through status to the business trust on interest and dividend income received by this trust from the SPVs through equity or debt instrument. Such income is taxable in the hands of unit holder unless specifically exempted, which is there. And if you see, there are 4 types of distribution which we have come across. It could be either a dividend income, or it could be an interest income, or it could be a repayment of principal amount of loan from SPV, or any other income which could be, let's say, which is earned by the REIT, basically the income from fixed deposit or mutual funds or capital gains, or a combination of anything like that, which is there. The issue which is what is covered an amendment is basically in respect of repayment of debt in the nature of income, for which department feels that there is an income element which is there, and therefore that should be taxed in the hands of the unit holder. And therefore, a new section 56(2)(12) is proposed to provide that any sum received towards repayment of loan, which is not chargeable in the hands of the business trust, shall be taxable in the hands of the unit holders. And the same would be taxable in the hands of as income from other sources. That means you will not get the benefit of the concessional rate provided under capital gains. Now, however, if this amount is distributed against the redemption of the units, then the cost which is there of that units can be reduced by the unit holder against the amount received, and the surplus only would be taxed. One more welcome part of it is the unit holders now are permitted to obtain nil withholding certificate under 197 from AO, with respect to the distribution of income by REITs or InvIT. This is a welcome provision, especially in basically in case of non-resident, because right now the tax is required to be deducted under Section 194 LBA, and there was no exemption which was provided. No enabling provision was provided under Section 197. Now I think we can make an application. Non-resident can do the same. Cost of acquisition or cost of improvement of self-generated intangible assets, other rights shall be deemed to be nil. This is very, very important amendment which has been brought in, and let's see how the repercussions are going to come up. As we all know, Section 55, which says deeming provision in respect of intangible assets such as goodwill, trademark, brand name, right to manufacture, right to carry on any business, and certain other intangible assets also. But what was happening is in certain cases of capital assets, the courts held that there would not be any capital gains. Why? Because there is no cost can be determined, and those assets were in the nature of development rights or transfer of FSI, life interest, management rights, contractual rights under the agreement, and it is therefore proposed to amend Section 55 to include a capital asset, basically any other intangible asset or any other right, and said that if you have not paid any sum, in that case, the cost of acquisition or the cost of improvement will be deemed to be nil, and you will be paying taxable capital gains on the entire transfer on the amount. Yeah, I would request our senior partner, Mr. Mahajani, to talk about on this.
Good evening, friends. At the outset, an apology. I have a bit of a sore throat, so my voice may appear a little hoarse. Be that it may, I will be dealing with some innocuous topics under the corporate tax regime. The first one is presentation change. Sorry, the first one is disallowance of payments made to MSME entities, micro, soft, and medium enterprises. It is proposed that payments to be made to MSME, which have been paid beyond the period of 45-day credit period allowed under the MSME Act, would be allowed as a deduction only in the year of actual payment. It is to be noted that whereas 43B allows substantial payments to be made up to the due date of filing of the return under Section 139(1), in the case of payments to MSME, it is specifically provided that only payments made actually during the year would be allowed as a deduction. The expression proposed is payment. So I suppose it covers all types of payments made to MSME. MSME enterprises would be those which are either supplier of goods or supplier of services. So whatever consideration is to be paid for such goods or services would have to be paid during the year itself if one has to claim deduction for such as a business expenditure. As you are all aware, under Section 23 of the MSME Act, interest that is paid or payable to MSME enterprises is not allowed as a deduction under the Income Tax Act. Now, this is an additional burden while dealing with MSME enterprises. Of course, the intention is to protect MSME enterprises and take care of their interests. Now, the question would be, what is the nature of payment? If suppose the MSME enterprises are supplying goods or services, and that expenditure has a direct bearing on the valuation of inventory, then the question would be how this disallowance would be dealt with for the purpose of valuation of inventory. Whether we would still deal with this cost as a part of inventory, or because the expenditure is not being allowed under Section 43B, whether we can seek a corresponding adjustment in the value of inventory. This only time will tell, and what the department would do in this, the law will evolve in point of time. The next topic is also a very brief one. valuation of inventories. As you are all aware, under Section 142 of the Income Tax Act, the assessing officer in certain set of circumstances is empowered to order for a special audit of the accounts of the assessee. Now, this he has to do by following procedure laid down under the Act. Permissions under the PCCIT or CCIT or PCIT or CIT as the case may be. Now, it is now proposed that he would also be empowered to order valuation of inventory by a cost accountant. First of all, the expression used is only inventory. So it is not clear what types of inventory would be covered by this expression. The cost of such special audit by the cost accountant would be paid by the Government of India. The period for obtaining this inventory valuation is proposed to be excluded while computing the period of limitation for the purposes of assessment. Now, this again could raise a host of questions. First of all, as we have noted in the presentation, what inventories are being referred to? Whether construction contracts, they have their own work in progress, whether those also would be covered. To our mind, they should be covered. Then the question would be whether where IPRs are involved and they get factored into the inventories, the work, the WIP that is there, or in the finished goods that are there, whether the cost accountant would have to be provided access to such to understand what is the worth of the inventory which he is valuing. Suppose there are no benchmarks available for evaluation of inventory. Then what would be the position in law? Would he be making an estimate of the inventory? So this again, the jurisprudence will evolve with passage of time, but there could be challenges. One more issue could be, since the valuer or the cost accountant would have access to our records, perhaps access to our IPR, whether any confidentiality protection would be required in the terms of a non-disclosure clause agreement with the cost accountant. This again will evolve with passage of time. The third brief amendment is to Section 35D, which allows deduction for preliminary expenses in an amortized manner over a period of 5 years. The expenditure which is covered by Section 35D includes expenditure on feasibility report, project report, market survey report, or any other similar survey. Earlier, this could be done only through a concern which is approved by the Central Board of Direct Taxes. Of course, the assessee himself could do this feasibility report or market survey, etc. And only then the cost would be allowed to be amortized over a period of 5 years. Now, by way of liberalization, it is proposed that the concern need not be approved by the CBDT. Only the assessee has to furnish a statement of the expenditure to the board, to the authority which would be nominated or specified by the board in this regard. The content of the statement, the form of the statement would be made known as and when it is prescribed. The next amendment is to Section 241, which is sought to be omitted with effect from 1st of April 2023. And the other is to Section 245, which corresponds. Section 241 provides for refunds. It provides that the assessing officer may propose to withhold refund until the end of assessment, if in his opinion, the assessment is going to result in some substantial demand. This would be to protect the interests of the revenue. Section 245 talks of set-off of refunds against taxes remaining payable. This requires the consent of the assessee. Now, it is proposed to merge or integrate 241A and 245, and this proposal, the provision to withhold a refund is now being moved to Section 245. The disconcerting fact is that for the period for which the refund is withheld in terms of the amended Section 245, no interest will be payable. So the money would be entirely available to the tax department without payment of interest. The next amendment is to section 94B, which deals with thin capitalization. It provides for disallowance of interest in certain circumstances where the amount of interest paid exceeds 30% of the earnings, that is EBITDA. Presently, exemption is available to banking companies and insurance companies from this thin capitalization rules. It is now proposed to include notified NBFCs for the purpose of this exemption. The next amendment is to section 28(4). Section 28 is the basic computation section of profits and gains of business or profession. 28(1) deals with the basic computation of profits and gains. It has various other clauses. 28(4) talks of benefit or perquisite, and presently the way it is worded is value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of a profession. Now what is proposed is that not only money convertible into benefit or perquisite, whether convertible into money or not, but even cash benefits or cash perquisites would be roped in. This section came into focus when the provisions of section 194R were being applied. As you all know, section 194R was triggered by the benefits or perquisites which were being provided to the medical profession, and which was also the subject matter of litigation before the tribunal, before the courts. Section 194R provided for withholding tax from benefits. The general consensus then was that cash benefits or perquisites will not be subject to TDS under 194R. The board, however, came out with a circular saying that cash benefits would be covered. Everybody thought that this was contrary to the provisions of 28(4). Of course, section 194R did not specifically refer to 28(4), though in the memorandum explaining the provisions of section 194R, there was a reference to 28(4), but the section itself was quiet on this. Now, with this amendment, there's a quietness that leads to this dichotomy between 194R and 28(4). A 28(4) would now encompass various cash benefits or perquisites. Basically, a perquisite or a benefit is something which is earned extra, in the sense that something which is not captured under 28(1). 28(1) deals with normal profits and gains which arise from the normal business transactions, such as buying of goods, selling of goods, buying of services, selling of services, and matters incidental thereto. And any remuneration, compensation, or income which flows from such normal operations is captured under 28(1). Already, section 28 has a host of clauses which brings to tax various elements. Now, some of these, in our opinion, already have shades of benefit or perquisite. For instance, cash assistance, duty drawback, even subsidy. Now, subsidies are not something which arise from the normal course of business. They are, as the argument goes, given ab extra by the government because of the schemes floated by the government to incentivize various state purposes, namely moving to backward areas, generating employment, etc. So 28, the arguments which were taken to say that subsidies were not taxable under section 28 were that, first of all, they were capital in nature, and secondly also that they were in cash, and therefore the provisions of section 28(4) were not applicable. Now, with this amendment, it would appear that subsidies would squarely fall under 28(4). However, it needs to be noted that section 2, clause 24, subclause 18, which deals with the definition of income, specifically deals with subsidies. But the interesting thing is that although section 224(18) defines subsidies and says that those subsidies would be in the character of income, there is no corresponding amendment to section 28 as there is in the matter of cash assistance or duty drawback, for which there are corresponding provisions in section 28 also, as there are in section 224. Now it would appear that despite the fact that there is no corresponding amendment in section 28, with this amendment to 28.4, subsidies would also fall under the head 28 as revenue receipts from business. To our mind, the argument that subsidies are not intrinsically in the nature of income could still be taken. Whether the courts would uphold this view in view of the fact that the section now specifically refers to subsidies as being in the nature of income, only time will tell. Now, various other cash incentives in the form of discounts, rebates, commissions, incentives, etc. These are ordinarily in the nature of business income. And if they arise out of the normal business transactions, then they would certainly get captured in 28.1. So 28.4, this amendment should not have any significant bearing on the position in law. One important litigation which emerged out of 28.4 is in the matter of loan waiver. Loans taken which are waived fully or partially. The question is whether these loans, the waiver is taxable under business income. Courts have taken a view that this being a cash waiver, provisions of section 28.4 would not apply. Of course, these loan waivers can never have been brought to tax under 28.1 because they were not arising in that sense from the ordinary conduct of business of that company. But now with this amendment to 28.4, it would appear that these case law holding that loan waiver is not in the nature of income chargeable to tax under 28.4 would no longer hold good. Loans at concessional rates, or for that matter, any other transaction which is at a concessional rate. Now that would contain an element of benefit or perquisite in the sense that the recipient of that transaction at a concessional rate stands to benefit or gain. So to that extent, there's an element of benefit or perquisite. Now whether that would be independently taxable is a question which will have to be decided. Ordinary or as it is with lower expenditure in the form of concessions or rebates or incentives, the expenditure would already be on a lower side, and therefore actually no further tax treatment is required in terms of 28.4. Of course, one has to remember that under 194R, tax will have to be deducted by the provider or the supplier, and for matching TDS under section 20 as reflected in 26A, perhaps we may have to account for such saving as income, or we'll have to otherwise demonstrate that whatever income is reflected in 26A statement in the form of concession, benefit, or perquisite is correspondingly somewhere or the other reflected in the financial statement. The more direct such representation, the better. So perhaps we may have to think of reaccounting for it, for such concessions or benefits. Similarly, points which are earned, maybe credit cards or travel points or any other points, which are available by way of credit and which therefore go to reduce the expenditure, I think they would also perhaps require similar kind of treatment of being accounted so that they are properly connected with the amount of deduction under section 194R. 194R is also equally being amended so as to specifically now cover benefits which are in cash, apart from those which are in kind. Benefits which obviously are not arising out of any business or profession, and to which therefore section 194R would not apply, would specifically get caught under 56.210, to the extent, of course, the section applies. The next, these are instances where cash perquisites could be visualized. Some of these I have already dealt with: credit card companies, dealers, distributors, incentives, interest-free loans, waivers, unclaimed trade advances from customers. This also could be an additional item of cash incentive or cash benefit or perquisite. Now, here the question could be, at what point of time this unclaimed trade advance gets converted into a benefit or a perquisite so as to be taxable in an appropriate financial year. This again will have to be tested. The next lot of amendments which I will be dealing with is those dealing with trust taxation. Somehow or other, it appears that the finance minister has a lot of distrust towards trusts. Every bill is replete with provisions dealing with taxation of trusts. This year too, there are about umpteen number of amendments, but the memorandum explaining the provisions dealing with these trust amendments runs into roughly 9 pages. So a lot of amendments have been suggested. I would be only quickly summarizing them. One is where corpus is utilized for application. That is not permitted. The alternative was that if the corpus is replenished, then that would be treated as application. Same is the case where loans and borrowings are not permitted as for application, but there is a repayment that is treated as an application. Now it is provided that such applications would also be governed by the regulations dealing with application. Then there's a period of 5 years which has been prescribed that only if what is replenished within 5 years or what is repaid within 5 years would be treated as application. Then it is also provided that where donations are made to other trusts, not by way of corpus, but by way of normal donation, then only 85% of such donations would be treated as application. This would mean that if the company were to if the trust wants to claim 85% deduction, then it has to shell out a larger amount of money. Roughly, it works out to about 118 as against earlier 100 for getting a 85% reduction. Then there are provisions dealing with registration, provisional registration, etc. These are something which need not be dealt with in this forum. Then the next important thing is that if the trust fails to get itself registered, it does not apply for registration after having obtained a provisional approval, or it does not seek re-registration, then according to the finance bill, this tantamounts to the firm, the trust exiting the exemption regime and entering into a taxation regime. Now, it is provided that at this point of time, the trust will have to pay what is known as an exit tax under Section 115 TD. There are other similar provisions in the case of 1023C, etc. So this is at the maximum margin rate. It will have to be paid within 14 days of the end of the previous year after calculating the amount of such exit tax. Then there is also a provision for requiring the trust to file a return under 139(1), 139(4) to get the exemption. Now, it is the only amendment is that you cannot utilize the additional 2 years that is available for filing updated return. The time provided is with reference to 139(1) and 139(4). Done. Now, my colleague Viksit will take over.
Good evening, friends. I'll run you through with the amendments which were brought in the sphere of tax reduction at source and appeals and litigation front. There were a few number of amendments which were made. However, I will be dealing with some salient ones. First of all, the claim of TDS credit has been a problematic area for various companies because the claim of TDS credit has to be linked to the income, and at times it happens that the income is offered in 1 year and the tax payment or TDS has been deducted in the following year or in any other year. In such cases, companies were not able to claim the credit of the TDS. Now, to facilitate this, to resolve this anomaly, government has introduced Section 155, wherein the government is empowering the assessing officer to allow such claim of credit of taxes to the companies on making an application, and that can be made within 2 years from the year in which the TDS is deposited. But it does not give a complete resolution. There are still points which the companies would be would have to ponder around. One would be reconciliation. The second point is, what if there is a tax deduction which has happened and it was deposited, but the company could not make an application within 2 years? In such cases, will that credit be lost? The answer may be no, but there is no mechanism which is provided. So the ultimate route which might be available might be of a writ application. Moving on to the next point, traditionally, uh, tax on gamings, like in the case of bettings, horse race, etc., was provided to be taxed at 30%. Accordingly, TDS was also required to be taxed at 30%. However, that tax was required to be deducted only if the consideration which was paid in excess of 10,000. Now it is provided that an aggregate consideration during the year which is in excess of 10,000, tax would be deducted only on such aggregate amounts. So one has to keep a track as to what winnings have been given to the assessee, and accordingly tax be deducted. A new provision is being brought in, which will, which I call it as taxing online games. So games which are offered on internet, which are accessible through a computer resource, including a telecommunication device, are being treated akin to the same gambling and bettings. It will be taxed at 30%. Net winnings will be liable to tax at 30%, irrespective of the payment is made or not, whether it is in kind. And even if there might be instances when the winnings are credited to a particular account but not withdrawn. The moment the winnings are withdrawn, even if it is partial, the tax would have to be deducted on the entire net winnings. So there could be an instance where it is being deducted, where the winnings are given in kind. In such case, the payer is responsible and obliged to deposit the tax before releasing such winnings to the person. Next amendment that they've brought in is they've taxed interest, even those interests which are coming from listed dematerialized securities, to be taxed at 10%. Moving on to the next slide, there is a partial relief which is given to persons who were not required to file return of income. They were earlier, in the earlier regime, taxed at a rate of higher tax rate because of amendments under section 206AB and 206CCA. Now, it is proposed that this higher rate would not be applicable to such persons who are not required to file the tax returns under the law. There was amendment regarding TCS rates in 206C1H, where 5% of TCS was proposed on remittances of foreign currency under LRS scheme and sale of overseas package. In this case, the tax rates have been increased to 20%. There is no threshold which was provided earlier. Exceptions have been provided in case of education loan. Education loan which are compliant with 80, section 80, the deduction would be, the collection would be 0.5%, others would be 5%, and medical treatment is also given a 5% liberal rebate of 5%. Then they've brought an amendment where there is a withdrawal of EPF. In that case, in absence of PAN, maximum marginal tax rate was applicable, which was 30% plus surcharge and cess. In such cases, a liberal rate of 20% is being proposed. Government has also clarified in case of joint development agreements that the consideration would be considered would include the stamp valuation of the share in that joint development agreement, any cash payments. However, there was some ambiguity which is being plugged now, is that it was considered that if the payments were through banking channels, they would not be considered, but it is clarified that those banking channels would be considered in all. So any benefit which is going through under the JDS agreements would be taxable. Next is I'll be talking about some minor provisions which came into effect for assessments and appeals. A new appellate authority has been defined. This is proposed to be defined. It is known as Joint Commissioner of Income Tax Appeals and Additional Commissioner of Income Tax Appeals. These appellate authorities would be able to address smaller tax grievances, appeals, and only those orders will be on order. They can only consider those orders of the AO which were passed below the rank of JCIT. Another very important amendment is that the TP documentation under section 92D would have to be furnished within 10 days, and when it is sought by the assessing officer, TPO rather, and it can be extended up to 30 days. Earlier 30 days was provided, so companies are advised to have the TPSRs ready much before a notice is issued by the TPO. Time limits for scrutiny assessments were proposed last year for 9 months. Now it has been extended to 12 months. And similarly, assessments for search and seizure are being extended by 12 months. I would now request Kumarwal, who heads our GST practice, to deal with the amendments in GST and customs duty. Kumarwal, sir.
Good evening, everyone. I'll quickly take you through the GST related amendments in the finance bill. The first amendment is with respect to composition scheme of taxation, which was earlier not allowed to those who were supplying goods through the e-commerce operators. Now the amendment is proposed to permit such persons also to take advantage of the composition scheme. However, those who are providing services through e-commerce operators have to still wait. They are not yet enabled. The next amendment significantly is with respect to the 180 days payment rule, which we are all familiar with. The invoice amount to each supplier has to be paid within 180 days is the mandate under the GST law. Now, what they have now done is, instead of adding the amount payable, that is the ITC which is not eligible and the corresponding interest, to the output liability, they have now amended the section to enable reversal of ITC along with the interest applicable. One further amendment here is with regard to the fact that payment has to be made to the supplier. It is not enough if payment is made to the tax department. The consequences of this is mainly controlled already in Rule 37, which was recently amended. And therefore, now the section backing has also come for all that was amended in Rule 37. In other words, see, now the entire provisions have been set right, both from the tax sections point of view and the rules point of view. Now, with regard to blocked credits, I'm sad to note that they are specifically blocking ITC for CSR activities. See, earlier also items provide or inputs which are provided free of cost in pursuance of CSR activities were no doubt restricted and credit was blocked. Now, in addition to that blockage of inputs given free of cost, they have specifically notified blockage of CSR activities related ITC, which will cover not only goods but services also. And the warehouse goods, which were neither treated as, sale from warehouse goods of customs bonded warehouse, were neither treated as supply of goods nor as supply of services. Now, they have now specifically added these kind of sales in the gambit of exempt supply. Therefore, reversals under Rule 42 and 43, the relevant formulae, will also capture these as part of the exempt turnover. And another significant amendment is Section 23, which relates to registration. Now here they have added a non-obstanding clause, which says notwithstanding anything contained in sections 22 subsection 1 and section 24. If you may recall, section 24 relates to compulsory registration. For example, those who were receiving taxable supplies liable under RCM and those making interstate supplies were definitely required to register irrespective of their turnover limits. Now they have provided relief to such people by saying section 23 overrides section 24 also. The question still remains whether this section overrides the levy provision. That is, RCM levy is under section 9, subsection 3 and subsection 5. That is still not overridden by section 23, which is only a procedural section. So here some disputes are expected and clarifications are welcome from the department. They have now sought to fix 3-year time limit for all the returns that are filed, 9C, 3B and GSTR 8, all of them. The tax returns pertaining to a particular period cannot be filed beyond a time span of 3 years. This is perhaps intended to give a finality to every tax return of a given period. The other significant amendment is section 54, which pertains to refunds. See, those who are exporters claiming ITC of accumulated credits because of predominance of exports are allowed 90% upfront provisional refund. Now, this refund in the unamended provision of section 54(6) was required to exclude provisional credits which were already sitting in your electronic credit ledger. In other words, 90% was allowed only after excluding provisional credits. Now they have dispensed with this because Rule 41 has already been dispensed with provisional credits. Whatever you take now under section 41 will only be actual credits available in the electronic credit ledger. So to align with amendments made in the last Finance Act to section 41, they have made this provision. Here is another significant amendment. Currently, section 56 which provides for interest on delayed refunds, explicitly said immediately after expiry of 60 days from the date of application till the date of sanction or receipt of refund. That was the lead time eligible for computation of the interest. Now amendments have been made to make sure that rules can be introduced to modify and define the delay period, perhaps by excluding time spent in litigation and time due to rectifications done by way of during the processing of refund claims. They may come out with rules after the amendment is made effective to make sure that litigation time spent is not part of the delay period. So you will not get interest for the litigation period. Now, penalty provisions have also undergone a change, particularly with reference to penalty for offences committed by e-commerce operators. Now, a penalty of 10,000 or an amount equivalent to the amount of tax involved will be the penalty for certain specified offences. Now, the provisions are also amended to ensure that unregistered persons who make exempt supplies are also allowed to make supplies through e-commerce operators. and interstate supplies are also allowed through e-commerce operators. And if the e-commerce operator fails to disclose proper details of TCS collected, then he will also be liable to a penalty. Then coming to punishments, that is prosecutions under section 132, they have removed 3 very serious offenses from the scope and ambit of prosecution. That is obstructing or preventing an officer from discharging his duties, tampering or destroying evidence, failure to supply information which is required and demanded by issuing summons and otherwise as mandated in the act. Now this they call as decriminalization of some of these offenses. Then compounding provisions for compounding fee have also been amended. First of all, subsection 1 of section 138, the language had to be corrected. That has now been corrected. The implications are that the fee for compounding of offenses is effectively reduced because the minimum and maximum limits of compounding fee have been modified. And no compounding fee will be, or the option of compounding will not be allowed for persons who indulge in false invoicing or fake invoicing. Then for sharing of details loaded onto the GSTN portal at the time of registration or at the time of filing returns, specific consent is being sought from, provisions are put in place to enable automatic consent from the taxpayers. How exactly they will obtain the consent remains to be seen when the rules are notified. And certain retrospective exemption is allowed in case of amendments made in 2019 with reference to non-taxability of out-and-out exports which happen outside the territory of India without coming into India. Similarly, high sea sales have been included in the Schedule 3 already in 2019. Now they are giving retrospective amendments, but in the same breath they are saying that for the old period, there will be no refunds allowed. So this may be challenged under Article 265, which says that tax cannot be collected or retained without authority of law. The other significant amendment is to the definition of non-taxable online recipient, where they have modified the language to make sure that any supply made to unregistered persons, including government departments, which are now categorized as unregistered persons, will be taxable. And one more important criterion, that the service of OIDR will qualify as such only if it is essentially automated and involves minimal human intervention. That criterion has now been given a go by. So more number of services coming from non-resident taxable persons outside India to persons within India will get taxed. It remains to be seen what are the new taxable services which will be coming under the scope of OIDR. The other significant amendment is to set right an anomaly in section 12, subsection 8, relating to transportation of goods. Now, section 12, as you all may recall, deals with supplies made between persons, that is where the supplier and the recipient both are within India. Despite that, the proviso to subsection 8 said that if the destination of goods is outside India, place of supply would be outside India. As a consequence, any transportation service supplied in respect of export goods which go out of India qualified as eligible for export of service benefits. Now they have set right that anomaly by saying that in such cases, irrespective of the destination of the goods, the place of supply will be deemed to be within India. The direct consequence of this is export of service benefit will not be available to the service provider nor to the recipient. Of course, the recipient will also be liable to pay tax under RCM, which they can claim under claim as an ITC and subsequently as a refund. As far as customs duty is concerned, I will restrict myself only to the rate changes in respect of automobile industries. See, they have reduced the basic customs duty from 30% to 35% for vehicles imported in CKD condition, and for electrically operated vehicles imported in completely built form, they have increased from 60 to 65%. And exemptions are provided in respect of some of the subsystems and components for testing of electronic vehicles, which are required for certification by specified organizations. And exemption from customs duty is provided to import of specified capital goods required for machinery required to manufacture lithium-ion cells for batteries, which of course is one of the concerns of those customers and consumers who want to possess electronic vehicles. So these are the changes significantly made in respect of automobile segment. Now let me hand over to Mr. Vikshit for the question answer session.
Thank you for listening to us and having a patient listening. Now we will have this session on question and answers. I've received few questions. I would request you, if you have any further questions, you can post it and we will be happy to address all of them. Now let me just take you through the questions that we have received and then we can give our comments on it. The first question is whether the payments term mentioned in PO can be considered as an agreement. This question is being asked from the perspective of relief which is given to MSMEs. The clear answer, MSME refers back to, the provision refers back to MSME Act section 15, which provides that the agreement has to be written, and in that section 15 there's a proviso which provides that it should not be greater than 45 days. So whatever your payment terms be, the extension would be limited only to the extent of 45 days. Another questions on MSME, whether the status of vendors, MSME or otherwise, needs to be checked every year. Actually, the moment a particular vendor becomes an MSME, the provisions will apply, and accordingly, of course, it is a practical difficulty in finding out when a person becomes an MSME or not. One has to keep a track of this and accordingly act. Next question, what is the benefit to company in income tax, employee tax workings and GST refunds in this budget? This is quite an open-ended questions. Kalpesh, do you want to take this?
Now am I visible and audible? Yeah. Okay. I appreciate this question. I think Really speaking, yes, there are not too many company benefits which have been provided, if I see that in the past there were a lot of incentive given to the manufacturing companies by having a lower rate of tax of 15%. IFC unit got a lot of advantage, but in this case, what I could think is, the startups which have got the extension for Section 80 IAC benefit and for Section 79, one can think of it immediately offhand. In case of NBFC, I think the thin capitalization rules will not apply. It's beneficial for from the perspective of foreign companies or foreign companies who have presence in India by way of subsidiaries. Uh, of course, in the seventh principle of Amrit Kal Saptarasi, there are some lot of investments which have been proposed in the infrastructure and the investment sector. In fact, allocation to the railway and logistics of around 75,000 crores has been allotted, which is substantial, and I think that should help us on an overall basis from corporate perspective. Coming to the employee part of it, of course, as I said earlier, only the individuals will be very, very happy from the budget perspective, because they have been benefited substantially. If you see, if you have an income of more than 15 lakhs, I said 55,000 is the amount of income what you get. Then there's a reduction of surcharge from 37% to 25% in case of people who are earning more than 5 crores, which is another benefit. Leave encashment has been, exemption limit has been increased. The standard deduction has been also been now available for new tax regime. 100% rebate for those people who are, earning income up to 7 lakhs, which is quite substantial. So I would say from the employee taxation, there is a substantial benefit which has been provided by the finance minister. And I think the reason could be very simple, is that you provide more and more funds to the people, and they will use the more and more funds for, their lifestyle and everything, which automatically will increase the consumption of the various goods, and we can expect the corporates making a profit out of that. Of course, as far as the GST refunds goes, Mr. Kumar, would you have anything on this?
See, with regard to amendments on refunds provisions, there are only two. One is to say that provisional credits will also, there are no question of deducting any provisional credits now. That is through the amendment to section 54(6), which now aligns with section 41. So 90% of what you apply for as refund will straight away come as a refund to an exporter provisionally. Okay, no deductions from that. The other point for refund is a matter of concern, in the sense that now one cannot rightfully claim interest for the delay period, including, in a simplicity of fashion, immediately after the expiry of 60 days till the actual date of refund. They are going to come out with rules and provisions to restrict the delay period, exclude certain litigation period involved in, ultimately succeeding in getting the refund and all that. That is not a benefit, it is a matter of concern.
So I'll move on to the next question. Kalpesh, this is for you again. The question is, with the removal of section 193 subsection 9, TDS is now applicable on listed and unlisted bonds. In case of listed bonds, which are cumulative in nature, how TDS will become applicable if I buy bonds on 1st March and sell them after 2 months in next financial year? Kalpesh.
So I think this is mainly because coming into position because of the exemption which was provided for the listed debentures, now that's been removed, and 193 would still apply. In that case, the tax rate would be 10% or so. I would say, in this, what I understand is, let's say I have a bond which is there of 100 rupees, and I had bought it at 105 rupees, and in 2 months or 3 months period, I sold it of 115 rupees, and I earned a gain of 10 rupees, which is there. The question would come is, whether I should be deducting, whether the TDS would be deducted on the same or not. Now, of course, this bond, what I understand, is being cumulative. I think would be payable only at the year, at the final, at the time of the maturity. And I understand there would be a clause to say, to support the same thing, that, this interest would be payable only to the person at the time of maturity, and it will become due to that person only on the maturity at that particular moment. if that is the case, I would assume, I mean, I would think, there won't be any TDS on that part of it for that 2 months or so. But and I think I would compare this with some CBDT circular which was issued, I think, in deep discount bonds and all, where such issues were always arising, where the bond of 100 was always issued at the price of 80, and the difference of 20 used to be always the case. I think CBDT came up with some circular on that, and I think they said that it should be deducted at the time of maturity on that. So I would say in this case, it should not be, because it's not due to you. And of course, there's a decision also which is there in case. So I think one of the Mumbai tribunal has decided that TDS has to be deducted only at the time of due basis, and I think it's ICICI Bank's case, which is to my memory, which is. Yeah, I just missed one more point. Yeah, thank you, sir, Manjani sir, for this. I think in that period, we would not be also aware of it. I mean, the person who wants to deduct it, he would not be aware as to who's the person who is receiving the interest income, and therefore, it's very difficult for him also to do the TDS on the same.
Thank you, Kalpesh. Next question again is for you. It is in respect of business trust. Repayment of debt to be taxable as IOFS and allowability of such income as deduction only on redemption of units. This will be recharacterized capital receipt, capital gains into income stream and tax it as IFOS. Whether this is the intention of the legislature, whether reduction of such repayment of loan from cost of acquisition of units will still be okay. Kalpesh.
I think this particular amendment, some of them which have been made in case of rate, InvAID, or for that matter, MLD and all, there I think somewhere needs little more conceptual aspect which needs consideration in such cases. I understand and appreciate that this repayment of how can it be treated to be in the nature of gain for that matter. I think it all depends. Like suppose if the loan is repaid by the SPV, I think I don't see any gain happening in that case. But yes, I think this is an issue. A representation would be required maybe to the government on this part of it to explain that whole concept. Of course, for non-residents, you will have the treaty benefits also. One would need to also take into that consideration. So I think, yes, this is an issue which is there and needs consideration, and we need a proper representation to it. I would say that,
So I'll take the next question. Whether the proposed cap of surcharge of 25% will be available to private discretionary trusts, since now AOP BOI also able to claim new tax regime under section 115 BAC. So you would want to take this question, Kalpesh?
I think this is a old sort of thing fighting going on, whether trust is an individual or an AOP and all those things. So I think it goes back to the concept, how do we analyze the status of the trust. There are judicial decisions which have said that trust is an individual, and at the same time there is also case laws to support the saying that one has to see the trustee for determining the status. And if you have the trustee as a corporate entity, what I mean, it will be a challenge. I don't know if you have one trustee, if you have another trustee as an individual, one as a corporate. I think those all issues are there, but I would say, I think the benefit should be available, in my view, and lower surcharge will be available, because even if there are many of them, it will still be an AOP which can be considered. Yes, correct. I think that's a point which is SP Manjani sir has said rightly, is that when you fill up the form, it's I think it shows as an AOP trust. So basically, even if once you say it's an AOP, I think that lower rate of should be also available.
So I'll start taking questions from the earliest ones. So interest on home loan to the extent not claimed under house property can be considered as cost of improvement. The answer is yes. The proviso does provide an exception. So this is okay. Then there's a query. Hi, I have a query in income tax on change proposed in giving powers to the assessing officer refund to adjust the refunds even if the AO has some suspicion. Would there be any implication on the past refunds arising out of court orders? conceptually, the moment a refund is due, section 245 gets triggered. Now, if the court has directed with conditions, section 45 may not trigger and the AO would have to give you the refund. This would again be a something where a litigation can happen. But conceptually, AO has the power to adjust those refunds under 245. Next question, whether amendments to section 194R is whether amendment to 194 is retrospective or prospective. I understand amendment to section is prospective. This will be prospective as laid down by the scheme. Let's see what the actual enactment. Yeah, so it is prospective. Then there is a question. Hi, sir. My query is related to amendments made in section 54 and 54F. The limit of rupees 10 crores is for single sale transaction, or it is cumulative limit allowed to assessee for multiple sale transactions done in multiple years. So the limit of 10 crores should be considered for each specific assessment year, but for each transaction, it will be difficult to say. For a year, it has to be seen 10 crores. Then if the amount of rupees 3 lakhs is paid as interest on borrowed amounts for purchase of house, rupees 2 lakhs is claimed under section 24, whether the difference of 1 lakh can be considered as cost of improvement. Technically, yes, but it should be seen from a practical standpoint as to how somebody would justify with documentation whether this has been claimed or not. Then there is one question. Are there any plan from finance minister to set aside or abolish the old regime, and if so, by when, so they may implement? I would leave it to the finance minister to answer this question, but we expect that this should happen, and your expectation is quite in the right spirit, I would say. I think I have covered all the questions. Yeah, there is one more which is there. Currently on OBU of foreign banks are granted FPI licenses and are allowed to issue ODI to non-residents. Whether offshore banking units of Indian banks can issue ODIs to non-resident? Kalpesh, you want to take this?
I think this is the main issue which is there from the FEMA perspective and from the IFC unit. We would need an analysis of the same. Of course, when they said about the offshore banking unit, what I could get there is from that, they were restricting the asset to only the foreign banks who are having a presence in the IFC unit, and they are issuing these particular derivatives to the non-residents. I think we would need to see whether whether the IFC unit and RBI would allow such type of thing. I mean, I think this needs a little more analysis of the same.
I think I'll take this last question. Can the salaried person opt for new or old regime each financial year? The answer is yes. Or once opted from the new regime, continued to follow old regime? I would say the answer is this. You can choose your scheme to be taxed accordingly. I think we are done.
I'll just add to that, Vikshit, there's something very similar was there also for this business income and for the salaried. I think business income, there was a saying that, today if you opt for it, the next year suppose you opt for it, the next year you may not opt for, you can have to compulsory. So there's a leeway which has been given for 1 year, you can do opting and not opting. But as far as the salary goes, there's a silence on that, and I think you should be able to do that same. Of course, you will have to see as to when to do it, whether it will be in the form of a return of income itself, you will have to do it, or there'll be a separate form. I think we need to wait and watch and see.
Thank you, Kalpesh. I think I've completed my questions which were posed to us. Any more questions? 1 or 2 minutes more, we can spend some more minutes on that.
I think I see one more question which is there is raised to say that, debt repayment. Let's say this is in the context of basically again backs to the return InvIT, where they have said that, any repayment of the loan or the debt would be again become an income in the hands of the unit holder. What the question has been posed is whether the debt repayment will happen, let's say in the first year 1, year 2, year 3, because 90% of the amount has to be distributed by the business trust to their shareholders. So let's say there's a repayment which is happening in year 1, year 2, year 3, and actually the unit redemption happens in year 4. The question is, in this case, unit holder will not be able to carry forward for cash loss, which is there. And is it a total loss to the unit holder? I think this is a typical business problem. I think we need to make a representation to the government, because these are very, very important aspects which I think the government or the person who was drafting has not foreseen this problem. I think an industry representation needs to be done, because this cannot work like this. I mean, doesn't sound to be logical, what they're thinking. So this is one question which was there. I think we have got some more 5 of them. I think in the interest of time, I think we can do it later.
So I think we are already past 6:30. We would be concluding this session. I would request Majni sir to say last few words.
Thank you, friends, for joining this webinar. We trust you found it informative. In case you have any specific queries, industry specific or specific issues, please to take them offline. So thank you once again and good night.
Thank you, everyone.
Thank you.
Thanks for participating.